Dividend investors love a good discount. We love to see stocks coming down in price because not only can you stretch your investment dollars further by buying at a lower price, but you're also able to lock in a higher dividend yield and establish a greater margin of safety. Still, it's important to remember that just because a stock is cheap, that doesn't automatically mean you should buy it. In fact, there could be a good reason that it's so cheap. And the Dividend King we're talking about in this video is a great example of that. We're talking about Leggett and Platt, a Dividend King in the consumer discretionary sector that makes stuff you may not notice, but definitely use. They specialize in making components and products used in furniture, bedding, and other industries. They make things like springs for mattresses, lumbar support for chairs, and other essential parts that make furniture comfortable and functional. So even though you might not see their name on the label, their products are essential in making your furniture usable and more comfortable. Now, Leggett and Platt is a pretty significant business just because of the products they make, and everyone loves a Dividend King. But there are some pretty hard to ignore red flags surrounding this company that wouldn't make me surprised to see a dividend cut coming up around the corner. Before we get into some of those red flags though, let's take a look and see what the share price has been up to lately. So we can see in the last month, Leggett and Platt has seen quite a big drop. They're down close to 7%. And then looking at the year-to-date performance, they are down quite a bit more. They're down 27.7%. Zooming out once again, looking at the last year, Leggett and Platt is down almost 39%. So a very big drop in the last 365 days. And if we zoom out once again, looking at the 5-year performance, they are down 55.3%. And as we can see right here, it looks like they peaked back in May 2021 at about $58 per share or so. And since then, guys, over these last 3 years, it's been a pretty steady decline down to where they're at now, just under $19 per share. We can see that they're sitting pretty close to their 52-week low. Now, with this drop in share price, as I'm sure you can imagine, the dividend yield has just soared way up into the sky, guys. It is way up there right now, and it is undeniably juicy. Looking at the stats here, the yield is coming in hot at 9.75%, just a hair shy of double digits, which in its own right is pretty incredible. But diving a little bit deeper into this, the forward yield is 106% above the company's 5-year average. Usually, guys, Leggett and Platt has a yield just about 4.75%. So right now it's more than double that. And if we take a look at the rest of the stats, like I said earlier in the video, Leggett and Platt is a Dividend King with a 51-year growth streak. Now on the surface, all of this looks like a pretty sweet deal, right? We've got a stock that's just really come down in share price with a dividend yield that's been pushed up ridiculously high, and it's a Dividend King. So that all sounds pretty good, but here's where we start to see some of the red flags. Revisiting these dividend stats here for a moment, look at the payout ratio, guys. That is coming in extremely high at 131%. This means that the company is paying out more in dividends than it's actually earning in profits. That's not good. I also think that in general, when the share price has come down as much as it has, and when the yield has been pushed up so far above the average like this one here, then there's gotta be some reason why that's happening. And if you're considering investing in this company or you think it looks like a pretty sweet deal, you'll want to investigate that. Upon doing so, sometimes you'll find that it's nothing to be concerned about, and the reason for the drop is some sort of short-term issue or macroeconomic situation unrelated to the company, which does happen. But other times when you look under the hood, you'll find that something is actually broken within the company, which in my opinion seems to be the case here with Leggett and Platt. One of the biggest issues is that this company is actually becoming less profitable over time. We can see this when we look on an absolute basis, as well as when we look at the profits as a percentage of the company's sales. And actually, starting with the sales going back to June 2021, we can see that revenue has trended down pretty consistently since then, which corresponds to about when this company started declining in share price. And I'm not saying there's necessarily causation here, but there may be a correlation between the two for sure. It wouldn't at all be unreasonable to assume that the share price is going down as a result of poor financial performance, which doesn't just stop at declining sales. Like I said a moment ago, profits have been trending in the same direction, and actually they've been doing so at a more aggressive rate. Starting here with the gross profits, just looking at the chart, you can see the downward slope over time, and gross profits are consistently becoming a smaller and smaller percentage of the revenue. In June 2021, Leggett and Platt had a 21% gross profit margin, while at the end of 2023, these margins have shrunk down to just below 18%. However, I will say when you look at the gross profit margins over the last 10 years, it doesn't look as bad. Back in 2014, they were still sitting at about 21%. So over the last decade, across a longer period of time, the gross profit margin still seems stable. However, when we look at the operating income over these last couple of years, it's the same thing as the gross profits. It's pretty much been cut in half over the last few years, with the operating margin declining from 11% to about 6%. And then if we look at the net income, the margins here have declined from about 9% down into negative territory at the end of 2023, which means they've actually lost money after accounting for their operating expenses, interest, and taxes. Or in other words, it means that the company is spending more money to operate its business than it's making from selling its products. That's not what you want to see, and as I'm sure you can imagine, that's going to put some pressure on the dividend. While Leggett & Platt is still a dividend king and has continued to increase the dividend as their financial situation has gotten worse, the payout ratio has definitely been trickling up, and since the end of 2022 has consistently been over 100%, which is not a good sign. It makes you wonder if a dividend cut is on the way. Now, obviously, I can't say for certain what's going to happen, and everything that we've looked at so far does look pretty bad, but there are still a couple things that lead me to think that a dividend cut may not be on the table. First of all, the dividend is still pretty well covered by the free cash flow and has historically been covered by it. The only year they paid out more in dividends than they generated in free cash flow was in 2021, where they had a near 140% free cash flow payout ratio, but otherwise it's been in good shape. And across the last 10 years, the average free cash flow payout ratio comes in at about 66.5%, with the most recent year being below that average. So that is a good sign. Another reason to believe the dividend will remain intact is because it still seems like the management team is committed to growing this dividend. The CFO was just talking about this in their most recent quarterly earnings call. He said, as we anticipate weak residential end market demand again this year, that's a mouthful, we are focused on maintaining our investment grade credit rating and managing debt leverage while balancing continued investment in our business for future growth and our dividend track record. Now, in my opinion, that's pretty clear cut, but still dividends are never guaranteed, and we'll just have to see if the management team is true to their word. Either way though, whether they cut the dividend or not, I'm still personally of the opinion that there are plenty of other better places to invest besides Leggett & Platt. And this is because at the end of the day, they're still losing profits, which I do think is a big catalyst for the drop in share price these last few years. And I don't know if that's going to turn around, and I can't help but think that at some point that will catch up to them. The only redeeming qualities I personally see in Leggett & Platt are its extremely high dividend yield and its extensive dividend growth history, but I don't believe it's a good idea to invest in a company solely because it has a high dividend yield and a dividend king status. Those two things alone don't make for a good investment, which begs the question, okay, well then what does make for a good investment? And that's what I'm telling you about in this next video right over here. In this video, I'm sharing my simple 3-step formula for researching stocks, and I'll tell you about some of the essential things you should be looking out for, as well as some things you should avoid. So click right over here to learn all about it, and I'll see you in the next one.